Barry Norton, good to see you. Candace, good to see you. Um, the yeah, I see others. I think Greg Reed, is that you? Good to see you. Okay, so I have 15 minutes and I have to bolt. I've got an appointment, so that necessarily means I have to go first. And then Brian will clean up whatever mess I create and finish it and take it across the finish line. So I think we should be. I tried to make some changes to the settings, but I'm going to double check. Okay, so that's working. So it's auto recording. That's an improvement, which means we can officially commence. It's June 12th. This is the Edge live demo discussion. We share strategies and thoughts here. And I am Tim Quast. Brian Wilson, market strategist, is with me as well. We're both old guys, apologies. But we do know some stuff. There's that. So I've got effectively four things that I want to talk about. I'm going to share my screen. I've got two screens here. I may use both. Hang on here. So the first thing I want to talk about, just very basic. So if you're new, I want to talk about using the daily trading ideas. How do you do it? When do you do it? I get a lot of feedback that people have success with this. In fact, I'm going to talk about a couple of instances. You could look at Insmed. I mean, you get lucky. Sometimes you just get lucky. I actually had just talked to the head of investor relations from Insmed. I've known him a long time. He was used to be at Pfizer. I saw him at this conference in Boston last week. Caught up, had lunch. I mean, he's a friend of mine. So I didn't know that was going to come. But it was an interest. I'll just plant that seed. We'll come around and look at it. But anyway, here's what I mean by using the daily trading ideas. So if you are new to Edge, and look, we're beginning once again after, people have been with us a long time. You have this relationship with Interactive Brokers. I'm doing some stuff with them. We removed the daily trading ideas there because we felt like they were not valuing the IP, and we're not giving that away. I am willing to be very patient with our IP because it's valuable. It works. Right? So once you give it away, you can't get that cat back in the bag. So I'm not doing it. That's just, and that's okay. I can live with it. We'll continue to do what we're doing. So here are the daily trading ideas. Here's what I like to do. You can sort by, if you want. You can sort at Barry. I think you sort by probability. You could go, well, I want the highest probabilities. Look there, it's math. At some point, is there that much difference between 67% and 100%? Well, it's a data set. And what we're doing, as you longtime folks know, is we're taking 90 days. Why 90 days? Well, it takes you through an index rebalance, takes you through a quarter, behaviors change, models change, people change their allocations to the market. You can overload a data model with too much data and cause yourself to fail because you're looking at too large a data set. So we find that this is effective. It takes into account that everything is constantly changing, which is why past performance is no guarantee of future outcomes. Money is coming into the market. Money is leaving. Views of risk come and go and change and adjust. So this looks back 90 days and says, under these conditions, did this stock produce a 2% or better return in 1 to 5 days? And that it happened every time for these particular ones. Again, that doesn't mean it'll happen in the future. I like to do this, sort by entry, because you can get a good bang for your buck with a lower price stock. So you could go say, okay, this gives me core mining. I can't remember what AVTR is. SoFi. This is a silver miner. No, it's no surprise, right? That what's showing up in the momentum stocks are things that reflect what is happening in the commodity market. Those are good things. Well, it does the work for you. You don't even have to do any reading. It's going to go do the work for you and give them to you. Then you're going to look at your entry range. Anywhere in here statistically will work because prices change a lot. If you have 3, 4 percent volatility. All we're after is 2. We want half of that, right? So then I could go look and say, well, what about CDE? Where was it today? Did it give us that opportunity in the entry range? Well, it's up, certainly. And if you said, well, right in here, it drops into the entry range. If you're watching, look, I like to do it in the last 10 minutes because the price will be very stable. It'll be the reference price, and then take the gain the next day. If you have time, however, you could do this, and now you just wait, right? I got it in the entry range, 924. Let's go look at this. 924 sits right on the high end of the entry range, but it's in the entry range. And then all you need is somewhere close to this figure to get your 2% return, right? That's it. And so you could have done it today, right? You take your pretty close, might be 1.8%, but you take your gain, right? Could I do that again? Well, let's go see. You could do it over and over. Does it work every time? No, but it's pretty effective, right? Here it drops right into the entry range, I believe. Let's go check AVTR, 1330. All right, if it's in the entry range at some point early on, well, it is, right? So it's right in the entry range, and then it went up to 1372. You're out, right? Take your gain. You could do this over and over, and it doesn't matter what the broad measures are doing. Doesn't matter what happens later. You are just taking your 2%. You're producing a 2% yield on whatever money you deploy. And if you can do that repeatedly, it is extremely effective. And that's what you do. Now, it's not going to work all the time. Certainly, you want to be aware of things like broad market sentiment. Where is it? Well, it's rising. So under rising broad sentiment conditions and constrained supply, probably a good idea. Really, it doesn't matter what happens. You could have good trade relations or bad ones, successful negotiations or failed ones. You can have a plane, which is horrible, plane crash in India, and yet the markets go up. How can that be? Because this trumps everything. It interprets it all. Ultimately, the market, the structure of it, market structure, determines how all of these things will impact the equity market. Do I think this is going to become a problem? I do. And we'll talk about that in just a moment. But meanwhile, you know that you can produce returns with daily trading ideas. So you do. And when it changes, it changes. Okay, so the next little thing is I want to look very quickly at InsMed, which was in the daily trading ideas June 9, right? So I think Brian bought it. Several of you sent me notes and said, well, I bought it in here, I think on maybe Friday. Maybe it was even on the 9th, and said, oh, I don't know how that's going to go. And then, of course, we don't know that the news is coming, but clearly somebody does, right? That's the beautiful thing about market structure. You don't have to know everything. Somebody already knows everything, and it's there because it's 10 out of 10 with falling supply. Very high probability of returns. So, and if this happens, take your gain. Don't do a makeup foul. The player gets by you on the basketball court and you run down and foul them. Don't do that. Once it's gone, it's gone. Supply starting to tick up. I mean, could InsMed post more gains? Yes, it could. I mean, once the supply side rises over trend, I would say the opportunity's done. But I'd still go look for something else, right? You could say GME, GameStop, was in the momentum portfolio here, and you could look at it and say, here, falling supply, demand at 10, good chance to produce 2% or more in a day from, May 30 to June 2. Now demand's deteriorating, and we don't know what's going to happen, but you could look at this and say, well, some people probably knew this stock could drop 25% today, which it did, right? You don't want to get caught that way. So you can always look at it, well, rising supply, falling demand, even this little uptick here, you don't want to be in that. Chewy, in our model portfolio, what I call the buy fives portfolio, which has done very well this year. I look at it, I don't know that they're going to drop with results. You just don't know. But certainly the supply trend changed. So again, I would say even though it's very low, there was certainly speculation that maybe after this tremendous run where it spent all this time above 5 producing enormous returns, 45, 50% returns, that probably it's time to leave. And when you see supply rise over the trend, wherever that may be, whether it's 30% or 50%, it's a good reason to leave. So they're just some nice little case studies. Now, quick observation, comment on what's ahead. So here's my observation. I nominally know the guy behind. Do you know what Estimize is? Estimize is basically crowdsourced estimates of corporate earnings. They're a supplier to Interactive Brokers, kind of like they're a content partner. And so I made an effort to talk to these other content partners. And he wrote I have a quant blog out, I think today. And then if you get the IBKR quant blog newsletter from IBKR, ours is at the top. And he's got one in there. And he said, he's a very experienced fellow, knows a lot about, he's a math guy. And he said, in 2007, we had what we called the quant quake. All of us, we all were running these quantitative models, much smaller than it is now. And all of a sudden, they all failed, including ours. And we went, what happened? And he said, it turned out we were all doing the same thing. Here's that I think there is the risk of a quant quake. I was doing some spot checking. So we have corporate customers and so on. And I was talking with one of them about some institutional holders. Trillium was one of these. And I spot checked some comparative funds at T. Rowe Price, at BlackRock, just a number of them, large cap funds. And I looked at the weighted average market cap in all of them. And it was all the same. It was all $1 trillion. Kind of amazing. Go look at those large cap funds. How is it they all have a weighted average market cap of $1 trillion? Well, I can tell you why. And this is what I mean about everybody being exposed to the same thing. There are only 11 stocks with market cap of $1 trillion. So everybody is exposed to these same things. Right? No surprise what they are. Well, at some point, when everybody's on the same side of the boat, there will be a problem. I don't know when that's going to happen. I've continued to say, I think we will see a return to volatility. There isn't right now because we're right at the point where the arbitrage mechanism between ETFs, the underlying basket of stocks, the options market, the derivatives, they're all about the same. And that's really actually when problems arise. So when I look ahead, this is my quick look ahead. I look at broad sentiment. I say, okay, well, it's rising. Unless something materially changes, it will peak based on the trend at the red line. And it will probably happen this, could be Friday, could be Monday, into options expirations next week. The supply side has stopped falling. It could change. I'm not saying it won't, but the daily read is rising. It's back almost to 55. And the all-time record high was right here, 54.8. Back here it happened. This was the high bar at the time, and the market imploded. Now you say, well, there were causes for that. Well, there was a coincidence, certainly. But I look at this and say, I continue to warn. I don't, beware that the risk that this happens again is still there. No matter what everybody says, it is in the data set. Everybody's on the same side of the boat. And so I look at that and say, I'm just cautious. You take your gains. If you have big, long exposure, have a little hedge. Just beware of those things. Okay, that is all. I'm 2 minutes beyond my target, but that was not too bad. So I'm going to hand this off to Brian, and we will not be here next week because Thursday is a market holiday. And so our team gets all market holidays off, and I hope to be out on a gravel bike. I don't know what Brian Wilson is doing. So we'll have to catch up with everybody the following Thursday. So I will see you then. Thank you very much, everybody.
Sounds good. Bye, Tim. I will be driving to Omaha that day. My My daughter's fiance lives in Omaha, and her fiance's brother is getting married in a week and a half. So we'll be heading out to Omaha. So we'll see what happens. Hopefully it'll be good weather and good time out there. I'm going to start off by discussing UVXY. I mentioned it in today's note, and I'll explain why I was looking at that particular trade. I mentioned the numbers this morning. I'll show you what that looks like. I'm trying to include these numbers in the daily notes when I have them. So S&P 500. This is just a report that we run on the investor relations side of things. And what I'm trying to provide for you guys when I do the notes is these two volatility numbers. So intraday volatility, the average during the last week, and then the average during the last 200 days. Now, this 200-day average, recognize that that's elevated a little bit. That used to be 2.1, 2.2, something like that. I'd have to go back and look. But because of the volatility surge in April, it increased this number. But you can see we're 50 basis points lower than we are right now on a 200-day basis. If we look at SPY, when I was looking at the data yesterday, that really stood out to me. So once again, SPY, the only ETF that we include in the database. And look at this one. So 0.8 versus 1.3. And actually, this is fairly close to our normal number. We're normally, and Tim talks about the 1-2-3 rule, but SPY historically runs about 1%. The S&P 500 runs about 2%. And if you look at those momentum portfolios, they tend to average about 3% volatility. That's when you hear 1-2-3, that's what that is in reference to. So SPY really caught my attention yesterday, and I just kind of tucked it away. And I mentioned to Tim, like, wow, just like Tim mentioned, everyone's on the same side of the boat right now. Everyone is selling volatility. Volatility has really decreased so much. And I started watching it a little bit more fervently. My thought process in the back of my head was, hey, maybe I place a trade before the middle of next week when we get into the middle of expirations. I ended up placing that trade a little earlier than I normally do because of yesterday's trading activity, and hopefully I explained that during this morning's note. This is what UVXY normally looks like. It's a difficult trade. I'll just be honest with you. I only place it every 4 to 6 weeks, and I only place it under like the conditions that I've outlined here. Where everyone's going on the same side of the boat, and we're coming up on a potential inflection point. So that's when I'll tend to make the trade. It tends to be a very short trade. This is a great example back in May. You get a quick upside, and that can be, 7, 8, 10%. Every once in a while, you'll get an earthquake, right? I used to live in LA. I'm familiar with earthquakes. This is a 7.5 earthquake. This is a 3.4 or whatever it might be. So it normally goes away very fast. But if you get a big event, that was centered around Liberation Day, and the surprises that came there. When you get a big event, it's going to stay elevated for a while. The smaller events go away really rapidly. So if you're lucky enough to catch 5 to 10% appreciation on some of that activity, well, you just take it and go your merry way because it's probably going to disappear again, which is exactly what's happening. I have a long position right now in UVXY. I'm up by 4 or 5% right now. I'm just going to hold it for a couple of days. In some respects, it's kind of a hedge for me. If we go into next week and we make it through next week's activity with no issues, okay. It didn't work as well as I hoped it would, but that's okay. I have my long-term positions anyway, and in some cases, this can be a little bit of a hedge as well. So just wanted to share with you, why I went into that position. And if you try to make that type of trade, just be aware of how fast that trade works to the upside, but then it disappears really fast as well. Let me stop my share screening for a moment, see if there's any. Greg, you'll be on a gravel bike. That's fantastic. So just wanted to see if I was missing anything there. So UVXY, I've discussed this topic before, but it's still as strange as it is. This is the closest comparison that I have. So this was 2020, the middle of the pandemic. We went through a very long period over the red line. So once again, red line, think of stretched conditions for the broad market, becomes a little bit overbought. This is kind of normal what happens above the red line. Gains kind of disappear. Everything just kind of fizzles out in terms of what's happening. And I'm pointing right here or right here as well. But this was an exception. That was 15% gains. And then the market just continued to zoom higher. The other correlation here is short volume. We had this huge short volume spike. Those short volumes stayed high for about 3 months until they finally started to get covered. So let's go take a quick peek now at where we're at in 2025, or right now. So this was the period that we were just above the red line. That was the second longest period of time that we've been above it. And our returns, red line to red line, about 12%. So an extreme outlier, normal returns above the red line are about 50 basis points. Here's a great example of what that type of trading looks like. So we continue to be in just the middle of a very, very big outlier. There's no other way to explain that. Let's go back to that 2020 timeframe for a moment, and I'll share with you what happened with that short covering that we eventually saw. So this was obviously coming out of the pandemic. We had the huge increase in short volume. There was, think of it as a meme stock effect. Everyone is so fervent in terms of buying shares that they're borrowing shares to facilitate buying. They can't find natural sellers. Short volume spikes as a result. That was actually a 3-month time period where short volume stayed higher. Now we were in a little bit of a different regime, if I can use that term. Those short volumes were about 48% at that particular time. Notice the short covering. Once again, it came about 3 months later, and then we dropped back down pretty significantly down to about 42, 43. So it didn't stay elevated forever. We eventually saw short covering, and then, that was more of the normal rhythm of the market that we would expect. Greater demand, low short volume, equals market gains. This would have been a little bit of an exception. So here we are right now. Once again, we're right in the middle of that outlier. We're 1 month into it in terms of those higher short volume levels. Yeah, does it equal something like this? I have no idea. But just be aware that even those short volume levels can be high. They can stay high, for a period of time. And if it's like 2020, as strange as that sounds, the market can continue to chug along at a higher clip. We're just going to have to wait and see how that plays out. Once again, this was about a 3-month time frame that we walked through for that particular one. I did want to talk for a moment about some of the divergence that we're seeing in the market. And it's interesting because it's coming in different pockets right now. If you look at, I call it my all equity portfolio, about 2,900 companies right now, a little bit of divergence there. Sentiment higher, short volume actually lower. Now, the Dow Jones is actually different. Short volumes rising in terms of what's happening there with the Dow Jones. We look at large cap, short volumes rising. Mega cap, short volumes rising. But then look at a couple of these other players. Mid cap, that's pretty good divergence in the mid cap portfolio. Solid demand, lower short volumes. Look at small cap, good demand, lower short volumes. And we're seeing that as well in other pockets. And let me just show you what some of those look like. It's in my Bitcoin portfolio. I'll share that with you in case you're interested in looking at the companies. There's different companies that you can capture there, but these are the ones that I'm looking at. Hopefully that was enough time if you wanted to capture that. But Bitcoin portfolio, let me drop down, see some of the other ones. I know energy stood out when I was looking at it recently. Oh, by the way, um, shorting. If you're interested in shorting, there's very little out there right now. Barry's short portfolio has barely any companies. My short portfolio has barely any companies. It's a very strange time from a broad market perspective. Look at communication services. That's solid divergence. Short volume really moving lower. You look at consumer discretionary, and that's pretty good divergence. Um, Staples moving higher, but energy, that's pretty good divergence as well. So there are definitely pockets of the market where we're seeing divergence at this particular time. We are coming up next week on a very busy macro week, and let me show you what this looks like. So if you ever look interested in the calendar, so just go to resources and then the expirations calendar. And let me enlarge this just a little bit. So next week, and I'll just walk you through it, but you can see the different, uh, what everything's pointing to here. But next Wednesday, it all starts. That's an FOMC policy update. That's the first day of options expirations. The calendar's different next week because Thursday is a market holiday. So next Wednesday, first day of options expirations, it's VIX expirations as well, and the FOMC policy update. Then Friday, we get to the last day of options expirations and S&P quarterly index rebalances. So we get the rebalance. That usually means heavy trading volumes. And then 1 week later, that's the Russell rebalance on the 27th. So a lot of moving pieces next week. Once again, when I was thinking about that UVXY trade, I was thinking about it in terms of this context with those big events for next week, especially. And once again, I use it as just a little bit of a hedge. I have a long-term portfolio, and I can do things like UVXY to hedge that if we do, see a little bit of volatility. In terms of what's next, well, we've talked about it a little bit with this busy macro calendar. Let's go take a look again at broad market sentiment, and I'll back this look up about 6 months, I think. What we will see sometimes coming through expirations, the market will be moving a certain direction through expirations, and then it'll change afterwards. We can go back to January. Generally the market was under pressure. This is expirations here, by the way. When you see those little squares, you can see that right up here. But we moved higher after expirations. So down into expirations, higher afterwards. This was a continuation. Actually, it was different. This is where the pressure really started. We were kind of sideways, slight tilt higher into expirations. That's when the market started to unravel, right at an inflection point, right during expirations itself. The next expiration cycle in January, the whole market was just a little bit oversold. I think hedge funds found a little bit of an opportunity. The market moved higher for a brief period of time. We had Liberation Day afterwards. The whole market collapsed. When did we get the market recovery? Well, after expirations in April, that's when it started to rally. This one we briefly saw, we kind of topped, briefly saw a little bit of downside, and then we saw a continuation of that, those further gains that started back in April. So just be aware, you hear us talk about inflection points. There's a reason for that. Often if you're down into expirations, you can often be up afterwards, or vice versa. Just be aware of that potential. Tim mentioned, the quant quake, that the risk is there, that everyone's on the same side of the boat at this particular time. I don't disagree with any of those assessments. As I showed you with short volume, these short volume levels are near historic highs. They're an extreme outlier. I shared with you what was happening back in 2020. Even though they are extreme, could we stay at extreme levels for longer? Sure. I don't know how that's going to play out. We're just going to have to watch to see, what happens as we come through expirations itself. But after that's a huge run over the last couple of months. After that type of run, just thinking to myself, it would not surprise me if we, went the other direction afterwards, or at the very least, where the market at least paused for a while. So just be aware that we are coming up on an inflection point. Chris, great question. I think with those, I want to say 90 days, and then we have to add those, to the database itself. So if you get names that you want us to have reflected in the database, just reach out to me or Tim, and we'll make sure that those get added. But I think we have to have 90 trading days. So thank you. That's a good question. Did I get stopped out on ENPH? I will probably, usually the way that I approach those, if they're down, by more than half of their volatility, I'll take like half of it off the table. So I'll be taking half of that ENPH position off the table today. So that's just the way that I approach it. Sometimes you'll see a little bit of a rally from that point, but I don't want to be sitting on a 2 or 3% loss and then have it turn into a 5, 6, 7% loss. So it's just the way that I approach it. Andy, I do not follow that. Do you want to tell me about that? You can turn your volume on if you want. Or if you want to type it in as well, Andy, that's fine. I do not follow that. I'm not familiar with that. Sorry. Um, are there any other questions that we can address today? Just from a big picture perspective, we are in the middle of just an extreme outlier. There's no other way to phrase that. Oh, huge run on Cecil. Is that in the database? Do you know, Andy? We can go take a peek. I'm not sure if it's there or not. Let's go take a quick look. I don't think it is. I think it would have popped up if it was. So I don't see it in the database. Maybe that's one that we can add if it fits the criteria. I'll ask our engineers afterwards if that fits the criteria for you. But just from a big picture perspective, we are in an extreme outlier. I continue to tread lightly in terms of my positions. Personally, I'm using that hedge with the UVXY, just because I think everyone's on the same side of the boat right now, and especially with next week's big market events. So that's kind of where I have landed at this particular time. Any other questions that I can address for everybody today? If not, once again, we'll be out next week, and we'll see you guys in 2 weeks. Thanks for being here with us. We really appreciate it. See you later.